we're trying to accomplish buying more puts than we sell. We're going to buy, in this case, puts at a lower strike, because obviously those are the ones out of the money versus the higher strike, the higher strike puts, which are in the money, with the inverse relationship of calls and puts there. So what we're going to try and accomplish here is using Verizon as our example. The dollar weighted put call ratio 0.84, obviously December, 36 days. We're going to do a same 1/3, and in this example, what we're doing is we're selling the 33 strike in the put, and we're buying the 32 strike, which is the lower strike. And 1-to-3 ratio again. We're paying 510 for the 10/30 type of trade. You can see our vol levels. We're buying a put that's out of the money, which has got a higher vol level on puts, because obviously you know how the puts out of the money are skewed versus the calls out of the money. And you see the different relationships of what the theta and the gamma is. We've put our ranges for the stock, where we think the stock could go on the upside. If it breaks out there at 34, then our interpretation of the stock breaking down is not probably going to be good. So maybe we need to adjust the spread or neutralize it. But we're looking for the stock to break and go to 31 or lower. The daily decay that we pay, you can see that we're collecting $9.44, which is the relationship of the puts that we sold versus the theta here at 0.0094 is the 944, and then the 30 that we are buying, the theta relationship is there. The 30 times that comes to the 2860. So we're paying 1960. So this is a pretty cheap put ratio backspread. But if there's a breakdown in the market, and especially a big breakdown in the stock, it's going to be a great opportunity to capitalize on that. So let's look at what this looks like as far as the spread. You can see our spread here. Here's the put that we sold at 87 cents, and here's the put that we bought at 46 cents, and all the Greeks relative to it. Let's look at what that's the shape of that spread is going to look like. So basically, obviously, the blue being today, it's very close to the expiry, because we're talking about a lower vol stock. And you can see on the downside of the movement, the price of the stock from the 32 change range down to the 25, 28, we start to pick up some serious PnL, both real time and at expiration. And just as I showed in the other examples, let's throw a little change in the volatility here to see what would happen with the position. There's a 40 that they're showing. Let's pump it up to 60. See, the stock's gone down. There's been a huge swing in the vol to the upside, and there's news. You see how the blue line, which was the position today, has just expanded. My favorite time trading was when I had a backspread on, and all of a sudden news come out and vol would go wild, and you just sit there and you're salivating because everything you're long, without any movement yet, has gone up in price, and it's a great feeling. The downside of that is the inverse relationship, is when you don't get that, and the vol that you start at, let's bring it down below, let's say 20 level. You can see that. Let me bring it down even lower. You'll see what happens. There's a current level. Let's move it down to a user-defined level. So let's really whack it and move it down to like a 12. And you see the blue line, which is the position today, just goes down. So in backspreading, remember, getting in the right vol is key. Understanding getting in before what you think may be an explosive move is key. And this is where Ferry comes in. He comes into great help by helping with his prognostication, the tools he's giving you with the charting. But still, even if you're not necessarily right with the direction, or not necessarily right, they could look on their own and see these tight vol ranges. It's time to get on and put on a backspread. It's time to take advantage of that. Even if you don't get the move, you may get the move the other way. I think that's really important, because getting in, to give you a real understanding of how vols work, and when you look at your positions and you watch how you get long on the way up because you're long more units than you're short. Same thing on the downside. When you're long more put units than you're short, you get shorter. Being able to make adjustments by either trading options or trading stock makes it very easy when there's movement. It's when there is not a lot of movement, when you have a backspread on, that you have to use some of the skill sets that you may have in seeing how prices have moved around a little bit, or trading the stock. If you like to trade stock, that's a great way to do it. You know, during the extreme vol situations of when vol in 08 expanded because of the subprime, the vol and all the crashes in 91, the tech bubble, the crash of 87, vols went to unbelievable historical levels in those periods. And if you were long it, you made an awful lot of money and had many opportunities to capitalize on that. If you were short it, you lost an awful lot of money. I happened to be short one stock and long in 10, and my one stock that I was short took me out of all my profit, all my equity, and took me underwater because it was such a big position relative to the other ones that I was massively long backspreads. So you got to understand your capital constraints. You have to understand your disciplines. I've always told you size kills. In that example, that was my lesson. It was an ugly one, but it was a lesson.